Share your screen.
Hi, everybody. I'm Ken Kirschenbaum. Today's what, the 19th? No, 18th. December 18th, 2025. We have a special webinar today given by Mitch Reitman. So you guys don't have to call him and pay him today. He's going to give you all this information without charge, I guess. We all, of course, want to reduce our taxes. One of the things that Mitch may not mention, which is a great tax reduction, a way to really reduce your potential this year of profit. You can pay legal fees. I'll be happy to send you an invoice. Let's just leave enough time so you can, write that check and send it out, right? Which I will be depositing. So just be careful about that. All right, anyway, I'm going to turn this over to Mitch. You all know who he is. You all know his credentials. He knows the alarm industry. If you guys are not using Mitch, you ought to ask yourself why, because your accountant I don't have to know who your accountant is, does not know what Mitch knows. All right, when it comes to this industry, he knows his stuff. Probably knows other things too, but that I don't know. Okay, I'm going to make him a presenter now. And his panel, his presentation is going to change mine. And we'll hold questions until the end unless they are absolutely vital. Okay?
Thank you, Ken. And thanks for thanking me up. And one correction I want to make is that it's actually the 20th, not the 19th, because I'm an accountant. And I tell you things are absolutely correct and totally useless. And so
I did that on purpose, Mitch, so that you can show everybody how smart you are. All right.
Yeah, absolutely correct and totally useless. Right. And can you see my screen, Ken?
Not yet.
Okay.
Not yet. Not yet.
Oh, show my screen. I gotta need to click on this. Okay.
Okay. Now
Are you seeing it?
Yeah. Maybe you may want to do you need to maximize it or do I need to maximize it? Okay. Okay, no, you're good. You're good.
Okay. So this is us, and here's my quick advertisement. This is what we do. We are an accounting firm that only does alarm and systems integrators, nothing else. We have over 300 clients and 14 staff people here in Texas, but we work in 42 states, and we're able to work in the other 8. We do valuations. A lot of them are for divorces, for partners that are splitting up, and for situations like valuing a company for the IRS purposes or for a trust. We do brokerage and we do due diligence. And so that's the end of the ad. And today we're going to talk about something that everybody should be doing this time of year. And that is getting ready for the year end and getting ready for next year. And before you can really get your tax planning done, you need to get your bookkeeping done. And that's one of the biggest issues we have with small businesses. They're not ready. They haven't done their bookkeeping. They've got piles of documents sitting around. So you should be on top of your bookkeeping now. And that's where you should be focusing and looking at where you stand and having an idea of what your income is. And be ready to pay in whatever taxes you're going to owe. Hopefully, you've taken Ken's advice, you've taken my advice, and you're an S corporation or you're an LLC that's a pass-through, preferably an S corporation. If that's the case, your income from your company is going to be taxed on your personal tax return. And you have to have paid in a certain amount by the end of the year, by December 31st. And there are 2 things you can pay, and it's either what you're going to owe in taxes, which most companies have no idea in December of the prior year, or you can pay in what is called the safe harbor. And you should know what that amount is. I'm not going to go through that with you today in the presentation. If your accountant hasn't reached out to you and talked about your safe harbor payment, almost all of my clients, we had a meeting in November or earlier this month, and they know what that number is. They're ready to write the check or make the deposit, and it's not going to be a surprise. The last thing you need to know is that on December 30th, you've got to rush down to the post office with a $40,000 check. What's even worse than that is to find out in April or May that you didn't write the check, and now you got penalties and interest and late payment issues with the IRS. So make sure that your bookkeeping is done, you have an idea what your income is, and that you covered yourself for this safe harbor payment or for whatever payment you need to make at year end. So a big issue right now is what's called the tax and Jobs Act, Tax Cuts and Job Act. That was what President Trump, when he was president back in 2017, the first time around, passed through Congress and had a lot of small business benefits. To get it through Congress, he agreed to let it expire at the end of 2025. So we're coming into the second to last year of this being around, and it will expire at the end of next year. The biggest provision for S corporations and LLCs and 99% of my clients is what's called the 20% qualified small business income deduction. I'm going to get into that in the next slide. There were some changes in individual tax rates that may go away next year. But the 21% corporate income tax rate, if you are a C corporation, which I'm hoping none of you are, it'll continue on after 2025. It's not scheduled to expire. But what you need to remember is that this is going away unless Congress extends it next year, and you need to plan accordingly. And so deferral of income and acceleration of expenses. Kim was talking about writing checks at the end of the year to get your tax liability down, and especially paying your lawyers and paying your accountants. And one thing he said was, if you write the check, he's going to cash it. But even if he didn't cash it in 2024, as long as you write the check and it cashes within a reasonable time after the end of the year, you can take the deduction this year if you're cash basis. And there's really no set answer to what expenses you should take, whether you should even take expenses at the end of the year. This is something your accountant should be having a conversation with you. We're going to get into a little bit of this to let you know. First year bonus depreciation is something that you hear a lot about. Your car salesman will say, hey, come down here and buy this truck, and you can write the whole thing off. And that's partly true and partly not true. Some vehicles, if the vehicle weighs more than 5,000 pounds, you can write this year up to 50% off of it, off in the current year. Next year, that's going to go to 40%. But don't go out and buy a vehicle just to take advantage of a tax advantage. We're going to talk about that a little bit later. But you shouldn't be making decisions based on taxes. You should be making decisions based on what's good for your business. And then once you've made the decision, then talk to your accountant about how to handle it best. So you should also consider shifting to accrual accounting. We'll talk a little bit about that later. But here's a qualified business income deduction. And this is why sometimes you may want to think twice before you run down and buy a $50,000 truck and write it off in the current year. So if you wrote it off in the current year, and when I talk about writing off a vehicle, to be able to write it off in the current year, it has to be over 16,000 pounds or not have a back seat. So a work truck or a work van, something without a back seat, is pretty obvious that's used entirely for work. You can expense now the entire amount of that vehicle purchase in the current year. A lot of guys think that's really great. Well, we have until the end of next year, unless it gets extended, the qualified business income deduction. That's a 20% deduction against your net income. So let's say you have revenue of $500,000 and you had business expenses before you purchase this vehicle of $400,000. That leaves you with $100,000 of net income, taxable income. If you go out and purchase that truck and expense it, now your net income is only $50,000. So your 20% deduction for that qualified business income would be $10,000. If instead you decided to depreciate that vehicle, your expense for the vehicle this year will be $10,000, which is your net income of $90,000, and makes your QBI deduction $18,000. Now you will get in the next 4 years a $10,000 deduction each year if you depreciate it, whereas if you would expense it, it's gone. So you'll keep getting the deduction. You'll eventually recover the entire amount, but this year and next year, when the QBI deduction is around, your income is going to be higher. And a lot of accountants don't discuss this with their clients. A lot of accountants say just expense everything and get your tax bill done. But over time, over the next 2 or 3 years, you'll end up paying more taxes if you expense that vehicle than if you depreciated it. So accrual accounting. Ken and I disagree on this, but I'll tell you, in this business, especially with companies that do a lot of residential monitoring, where you bill quarterly and you bill semi-annually, accrual basis can be better from a tax standpoint. So let's look at a $10,000 amount of RMR that's billed quarterly, and you bill it, that should say 12/1 of 2024. So you bill it on 12/1 of 24. So you're billing for December, January, and February. So you're going to bill $30,000 because you're billing for 3 months. And let's say your customers that you bill pay you, most of them pay you in December. So on a cash basis, you're going to have $25,000 of income. You got $25,000 of payments from the $30,000 of billing. On an accrual basis, you only earned 1/3 of that. You only earned December's RMR. So you would only have $10,000 of income from that customer base. Now you're going to have income in the next year in January and February. So this is a one-time thing, but it pushes that income off to next year, that $15,000 of income off until next year. But more important than that, it helps you run your company because you're only seeing the $10,000 of income that you actually earned in that period. You'll see January and February, $10,000 of income on the accrual basis, where you would have seen zero in January and February. And that's one of the biggest issues a lot of company owners run into. They bill their customers quarterly, and their income from monitoring will fluctuate, and they're really not sure how much RMR they have. And so that's why we like accrual accounting, and that's why we think it's more accurate and helps you understand your business better. The other nice thing about accrual accounting is if you had a bill for work that was done in 2024, you don't actually have to pay it under accrual accounting. You enter it into your accounting system, you get the expense in the month you enter it, and it doesn't really matter when you pay it as long as you eventually pay it. You get the deduction the year that you got the services. So one question I get from a lot of alarm companies is holiday parties and gifts. It's the end of the year, you're taking care of your employees, you're giving them gifts. What can you deduct? What can't you deduct? If it's a gift to a customer, you can deduct up to $25 a piece. And if there's incidental expense on that, like postage or something else, you can deduct that as well. But if you're giving them $100 gifts, you could run into an issue, especially if it's a select group of customers you're giving those gifts to. I've never had this come up in an audit, but that's what the rules are. If it's a gift basket, then it needs to have a $25 market value or less. Gifts to employees, I call this the holiday turkey rule. So it's the $25 market value there too. If you give your employees a gift that's less than $25 at the end of the year, you can deduct the entire amount as an expense. What the intent of this is to keep you from giving your employees a $500 gift at the end of the year that's really a bonus, and not taking out FICA on it, and not taking out income tax, and not reporting on their W-2s. So you should be careful with this, because that is one thing that revenue agents look at when they do an audit, and it could get you in a lot of trouble if you've given away a few $1,000s of gifts to employees that were actually compensation. So holiday parties are 100% deductible, as long as it's not only highly compensated employees. So if you have a holiday party for all 50 of your employees, and everybody's invited, everybody gets to attend, with very few restrictions, that entire party is deductible. If you take your top 10 executives, or you take your son and daughter that work in the company to Mexico for Puerto Vallarta for the weekend, that's highly compensated employees, and that can cause you some issues, and you need to be very careful about that. Charitable gifts. That's one thing I see a lot of companies do. They will give away charitable gifts, but they're really marketing expenses. So if you donate, let's say you donate a free camera system to an auction for a not-for-profit that you're active in, that is really more of a marketing expense. If you have a sign up there that says ABC Alarm Company donated this camera system, I would put that into marketing expense, because if it's a charitable gift and you categorize it as a gift, there's a 10% limit of your S corporation income that you can deduct, and it's going to flow through to your personal income and run into some personal limits too. So think it through. If you're giving something away to a charity and it's really advertising, that's marketing expense. And one thing we do with all of our clients is we look for those things and talk to them about recategorizing that as marketing, because then it becomes 100% deductible. So energy tax incentives. I'm getting a lot of calls lately about energy tax incentives because people are afraid they're going to go away. It's probably too late to do anything about that this year, because you have to sign a contract and have an installation date set up. But if you did do it, the credits are based on when the contract is signed. We're seeing a lot of companies that are getting some energy work done that qualifies for the credit, but the contractor can't start until January or February. But if you sign the contract in 2024, you can get the credit this year. But be very careful about how you approach that, and make sure whoever's doing your taxes really understands energy credits, and make sure it's the proper way to do it. So another thing we see a lot of times, and I saw it this morning on a CPA roundtable I belong to, is distributions in excess of basis. And what that means is how much money have you invested in your S corporation, and how much money have you gotten as far as cumulative income, cumulative earnings over the years. That is the limit on what you can take out, but you are allowed to take it all out. So here's an example that when you set this a new business, the owner set it up, put $10,000 into it. This year, they had $330,000 of taxable income. So what we call the basis is $340,000. They paid $330,000 in income tax on their personal tax return for that income. They contributed capital of $10,000 that probably came out of their pockets for money they'd already paid taxes on. So tax has already been paid on that $340,000. So they can take up to $340,000 out of that company tax-free. And that's one thing a lot of S corporation owners don't understand. They don't understand they've already paid tax on that money. And if they cut themselves a distribution check, that's tax-free. So they could take up to $200,000 out of up to $340,000. They take $200,000 out, then there's $140,000 left for next year. The problems that you run into is if you took more than $340,000 out of the company, say you took $400,000, that's a distribution in excess of basis, and you have to pay tax on that because you've never paid tax on that $60,000 before. So this is another thing you should be talking to your CPA at the end of the year. What's my basis? How much can I take out? More often than not, I will see companies that don't really understand this, and they've got $300,000 or $400,000 sitting in their bank account, and they're afraid to take it out, and they're not able to come up with money for some of their personal expenses because nobody explained to them that they can take this money out and use it personally and not pay tax on it. That's something that your accountant should be talking to you. It seems complicated, but it's not that complicated, and they definitely should be tracking that every year when they do your tax return. So state and local tax payments. And as part of the 2017 tax bill that we talked about earlier, they placed a limit of $10,000 on state and local income tax, state and local property tax, sales tax, all those things that were deductible and limited before then. There's a lot of talk about that being lifted in 2025. We're not sure what's going to happen, but it's a very political issue. But some states, New York, California, a few other states, allow you to pay your state corporate taxes for an S corporation at the corporate level and deduct it as a deduction. And that way, there is no $10,000 limitation. It's very complicated. There are a lot of deadlines. It's something that your accountant should be talking to you about. If they're not, you need to ask them about this because it's not uncommon to have one of our clients that are paying $30,000 or $40,000 a year in state income tax on their company, and they don't do it this way, and it flows through their personal return, and they're limited to a $10,000 deduction, and they leave $15,000, $20,000 in tax breaks on the table. So talk to your accountant about those things. Retirement plans. Retirement plans are a good way to reduce your income and a good way to obviously put money away for retirement. But you need to be aware of the different retirement plans that are out there. And we already talked about that qualified business income deduction. If you're taking a deduction for a retirement plan, then you're losing income. You don't get as much of that deduction. So there's a traditional IRA and Roth IRA. We'll talk a little bit about that in the next page. A SEP IRA allows you to put 25% of salary contributions for business and owners and employees. The problem is you have to make that available to everybody, not just you. A simple IRA allows employee elected or employer max contributions up to 3% of salary or a non-elected contribution of up to 2% for each eligible employee. They're not that hard to set up, and they're a great benefit for your employees and something you should consider. But also, you have to make that available to all the employees. If they choose not to participate, that's fine, but you have to make that available. A solo 401k allows self-employed owners to contribute as both employer and employee and has higher limits than an IRA. It's a little complicated to administer, and obviously it's too late this year to try to set one up, but you may want to talk about setting one up for 2025. And a profit sharing plan allows you to share a portion of your profits with your employees and has tax benefits and flexibility. I like this a lot better. I get about 10 or 15 calls a year from my clients that want to give their employees some stock in their S corporation. That can be very, very tricky because now you've got another owner in your company and it presents some legal issues. And if you're doing things like taking advantage of tax breaks that reduce your income, you'd have an employee complaining. And then when they leave, you could have an employee that owns part of your company and you're kind of stuck as to what to do. And Ken will tell you that caused a lot of legal issues. You're best off to go with a profit sharing plan or a solo 401k and compensate your employees that way. They're getting a check or they're getting a retirement benefit. They don't care how it's coming, and giving them stock in your company is a real mistake. So personal IRAs are sometimes the best way to go. If you're going to be taking less than $14,000 if you're married and putting into a retirement plan, it's best to just handle it at the personal level on your personal return. You write a check to your bank, you set up the IRA, you're done with it. It's not very complicated. You don't have to offer it to your employees. You still get the qualified business income deduction. But all these things are things your accountant should be talking to you as you get toward the end of the year. And even if they charge you a couple $100 to go through your return, this is money well spent. So there's the limits have changed. They're up $500 over 2023. If you're over 50 years old, you can put away $7,500. $6,500 this year, $7,500 for 50 or older. So sometimes just doing a simple IRA is the best way to lower the income, because you're not lowering your corporate income, so you're getting your QBI, but you're lowering your personal income, and that's what you pay tax anyway. So Ken talks about this, and I talk about this with my clients, and something you consider is the end of year checkup. The most important thing you should do in this business is to seriously consider, if you're a C corporation, electing to be treated as an S corp or an LLC. I like being an S corp better because it's a separate entity. It is a separate tax return. An LLC, especially if you have one owner, is considered by the IRS to be a sole proprietorship. You still get the legal benefits of the LLC, but it's a sole proprietorship as far as the IRS is concerned. And what you will run into with that is reported on Schedule C of your tax return. And I've been talking about this for years, and we have a new client that we just picked up, and their LLC is being audited. And the typical sole proprietorship is a guy that does contract computer programming or a real estate salesperson. And sometimes they may have $150,000, $200,000 of revenue, but not much more than that. This company had $7 million of revenue, and it's got a whole different set of income and expense factors than somebody usually sees now in a sole proprietorship. And this revenue agent that's doing the tax audit is completely confused and can't understand why this company has $300,000 of vehicle expense. And the reason why is they've got 20 trucks. This is not just a sole proprietorship guy driving his car around and expensing mileage. So it's taken a lot more time than we thought it would. I think it got picked up and selected for audit because of the total revenue it has. It's just another reason to elect S corporation treatment. Now, one of the things you have to consider is if you decide to become an S corp, it's too late to do it for 2024, but you can do it in 2025, and you have to make the election by the 15th day of the third month. So you have to make that election by March 15th. Once you're already in business, it's too late to go back and do it retroactively. If it's a brand new business, you can, but once you're in business, you have to do it by the 15th day of the third month. And what I see a lot of, the reason why people are C corporations is their accountants don't understand their business. They don't understand when they have accounts that they could sell when they get ready to retire. And they set up as C corporations. They pay 21% tax on their earnings. And at the end of the year, they write themselves a bonus check and pay FICA on it and get their earnings down as far as possible and pay that 21% tax. But then they come time to sell, and they can't sell their company because the taxes will be too much. And the reason why is if an S corporation sells, it's mainly capital gains, and the owner pays 20% capital gains tax on the selling price. The C corporation sells, the C corporation pays 21% tax at the corporate level, and then when the owner takes the money out of the C corporation, it's a dividend, and they can pay as much as 37% income tax at the individual level. So that can end up giving you over a 50% tax hit as opposed to just 20% with an S corporation. So if you are a C corporation, talk to your accountant and find out why. And if they don't understand what you do and you don't understand the tax consequences, you really need to look around. The other thing you should do at the end of the year is make sure you have a succession plan. You're either going to walk out of your business or they're going to will you out of your business. And if you have kids that want to be in the business, now is the time to talk to an attorney about forming a trust and having a way to transfer this to whoever you want to transfer it to, and have a way to get around having any probate and gift tax issues now while you're alive and competent. If you're going to sell, then we'll talk about that you need to make sure you have everything in place to sell. Now's a good time to do it. Make sure you have monitoring agreements with all your customers. Make sure they're good agreements. And one thing I can say about Ken is I can't tell you how many times we've asked a seller about their monitoring agreements, and they said they're Kirschenbaum agreements, and we knew we weren't going to have any issues. If you're using Ken's agreements and you go to sell your company, I've yet to run into a buyer that had any issues with Ken's agreements. So be very, very sure that you've got monitoring agreements. Now, if you've done stuff like sign agreements, even if you use Ken's agreements and you sign agreements with property management companies, with governmental entities, with other people that make you use their agreement, and you didn't get Ken's people to look at your agreement before you signed it, and you didn't use his concierge service, then that's probably going to be a monitoring agreement that's going to have some issues, and it's probably not going to get purchased. And now's the time to start looking at that and see if you can fix that, not when you're in the middle of a sale transaction. You also need to have employment agreements with your key people. And that's another thing that Ken's firm is very good about doing, is helping companies come up with employment agreements, because you don't want to find out when you've got a complaint, when you've got a problem, that you didn't have an employment agreement with this employee. And I see this over and over again on some of the social media websites. I've got an employee that's doing this. I got an employee that's doing that. I got an employee that got drunk and crashed the truck. The first question is, what's their employment agreement say? What can you do? What can you not do? Ken's firm is excellent at helping you understand the nuances of alarm companies and employment agreements. So that's really not a tax issue, but it's something you should know to run your business better. Your billing and management software. 95% of this industry uses QuickBooks, and QuickBooks is really not meant for this industry. QuickBooks is meant for a mom and pop company where pop installs the product, or pop sells the product, and mom sits home and does the books. As you start to grow, you'll start running into issues with QuickBooks. One of the biggest issues is you can go back and fix mistakes without anybody knowing about it, unless you had it set up properly. And more often than not, I'll see a company hire an outside bookkeeper. They're making unbelievable amounts of mistakes, especially on customer billing, and nobody knows about it. And it builds up and causes them all kinds of issues. The other issue with QuickBooks is that QuickBooks really isn't meant for a company with as many transactions as an alarm company has. It's meant for a company with maybe 100 customers, maybe 40 or 50 vendors. In the alarm industry, the 40 or 50 vendors, it fits into QuickBooks pretty well. But if you have 1,000 customers, every month you're generating 1,000 billing transactions, 1,000 payment transactions, and that starts to build up. And if you're using the QuickBooks desktop in your company, every month you're generating 2,000 transactions. So every year you're generating 24,000 to 30,000 transactions. So after 3 or 4 years, you could have a couple 100,000 transactions. Every time you print a report out of QuickBooks, it goes back and reperforms all those transactions. And so people start seeing QuickBooks get slower and slower and slower, so finally it dies. And if you want to live through hell, try getting QuickBooks customer support on the phone. Now, if you're using their online version, you're a little better off because they can handle that. They can handle the volume. But QuickBooks is not what you should be using. It doesn't manage your customers. It doesn't manage your workload. It doesn't help you schedule your texts. It doesn't help you handle service tickets. So it's really time to start looking at some of the industry-specific software, and there are quite a few of them that are on Ken's Exchange, and that's where you should start. You should have your books closed for 2024 by the end of January. We're working with a company right now, 3 or 4 of them that still haven't closed their 2023 books. They have no idea what they made as far as income in 2023. They haven't filed their tax returns. You should have your books closed by the end of January. And if your bookkeeper can't do it, then you should talk to somebody. And if your accountant's not concerned, you should start looking for another accountant. There's really no excuse for that. So beneficial ownership interest reporting, you're hearing a lot about this. And you may have heard that last week an injunction was issued here in Texas in the federal court, and they suspended the requirement to file beneficial ownership interest reporting. But the Justice Department stepped in the next day, asked for the injunction to be lifted, and they're going to fight it, and they've got the resources. I don't see this going away. And as it stands right now, if suddenly this is reversed on appeal, you may find you're having to do this beneficial ownership interest report by January 1st of 2025. And you need to get started on it. I know that Ken's concierge clients, they'll do it as part of the concierge service. We have a portal that will do it in as little as 5 minutes. The critical thing that we have with our portal is it saves the information. So if you make a mistake, or you need to go back and change something later, or what we were finding before the injunction was issued, people would go to file it and the system was overloaded and it crashed and they had to go back and enter the information all over again. With our portal, you can save it and you can send it at 3 o'clock in the morning or something when they're not quite as busy, or if it crashes, you can just keep sending it again and you can submit and make corrections when you want to. So that's something to consider, that this isn't going away either. That is the end of the tax planning. I'm hoping there's some questions out there. Ken, are people sharing questions now?
Okay, just a second and I'll let you know. Just like I am with my accountant, no questions. Anybody have any questions for Mitch? I don't know, Mitch. You know, when I listen to my accountant, it goes in one ear, out the other, and maybe that's what was going on here. Who knows? Well, we don't have any questions, so if Mitch, you're done with your presentation, we're going to. Oh, here we go. What do you recommend in place of QBO?
There's several industry-specific software, and almost all of them are on Ken's Exchange. And everything that's on his Exchange, we've worked with and we've been really happy. I don't want to recommend one over another, but if it's alarm industry-specific, I'm really not aware of anything that's a problem. But there are two different ways you should look at it. If you do a lot of installation work and you have a lot of complicated jobs and a lot of complicated purchasing, I would look at one of the ones that are also a CRM, a relationship manager software that is very heavily into purchasing, very heavily into job costing, very heavily into scheduling your technicians and scheduling your work in process. If you're more of a simple installation, say a residential company that's the same thing over and over again, then I would look more at some of the software that's based on tracking RMR. The ones that come to mind are CSS and MicroKey and Sedona and Alarm Biller. They all help you track your RMR. They're good at billing recurring revenue. One nice thing is they produce reports that are really nice to see. Most of the software that I'm talking about produces a report to tell you not only that 15 customers canceled last month, but why they canceled. They moved, they died, they weren't happy with your service, they found another provider. Those are reports you should be looking at every month to see what's happening to your RMR, because that's your biggest asset. The other thing that they can do is that they can help you, when we talked a little bit earlier about accrual accounting, what your earned income is. If you build out $45,000 of quarterly RMR last month, $15,000 of it is going to hit your income this month, and $15,000 next month, and $15,000 the next month. You don't have to do anything. It does that automatically for you and puts it into your income category. And that way you're not in a situation where you have $45,000 of income this month and zero next month and zero the next month and then $45,000 of income again. It helps you smooth that out a little bit. The other nice thing it can do for you is print what's called an RMR at risk report. And that RMR at risk report, you can set it for 60 or 90 days or 120 days. It'll show you your customers that are starting to get a little bit past due, and that may give you some concern and something you want to go out and look at and figure out why they're not paying you. It could be that they're just lazy and they pay you whenever they get the next invoice, or it could be that they're waiting for a service call or waiting for an issue. Most of my better managed clients pull these reports and have their people look into them and understand them. The other nice thing to have is an RMR roll forward, which the software produces, and that tells you your beginning RMR at the end of each month, how much you added, how much canceled, rate increases, decreases, any of those things, and what you ended up with at the end of the month. And you can use that to analyze your attrition rate, and you can start looking for issues like we had this happen, we had these customers cancel, or we lost this big customer. But it helps you keep track of your attrition. And believe me, it's important to know your attrition in this business, because that RMR asset is roughly $1,000 a customer. And if you're losing 10 customers a month, you're losing $10,000 a month in value of your company. That may be acceptable or may not. And so that's something you need to look at. But I would look at the exchange first for the software. And if you have some questions about it and you're our client, we're glad to talk to you. We're familiar with them all. But Ken does a very good job of vetting the software companies on the exchange. And that's where you need to start your search.
Okay. I want to I want to raise one question, which is Mitch mentioned that the two of us, we agree on almost everything that I can think about, although I'm not an accountant, but we don't agree on this accrual versus cash basis. So I've been operating a business for a long time, and Mitch has been doing tax work and accounting work. I'm going to guess 25 years, Mitch, 30 years,
42.
42 years. Okay, so it's not that bad. He was just getting out of high school when I started my business. Okay, so here's the problem in my mind, and he'll correct me if I'm wrong with accrual. Now, who am I talking to, by the way? I'm talking to the companies that let's say your alarm company generates in gross revenue under $3 million, maybe under $5 million. Okay, that's who I'm talking to. You basically you run your company. You're the company. You're the board of directors. You make the decisions. You need to know what's going on. I get a kick out of so often when I hear from people, like talk to my friends. I go, why don't you buy a new car this year? They go, oh, I got to call my accountant. How could you have to call if you have to call your accountant? I don't think you can afford a car, okay? Or you really don't want one. How could you not know what you can afford and what you can't afford? Either you have the money or you don't have the money. That to me is very simple. Either you know what you can afford in debt service, or that meaning what you can pay out on a monthly basis, or you can't. Okay, why someone else would need to why you would need to call somebody who has hundreds of other clients on his mind besides you is something that I just don't get. All right, you need to know your own business and be responsible for yourself. Now how does that tie into accrual versus cash? Okay, how would you like to get to the end of the year or close out the end of your year? And now you're into January, calendar year's over, assuming you're on a calendar year. Of course, you could be messed up with accountants. I don't want that to sound like a dirty word, Mitch, but you could be messed up because you're not even on a calendar year. You're on some what do they call it, accrual year or something?
Fiscal year.
A fiscal year, right? So all of a sudden you're thinking December and you should be thinking March or June. Okay, so but let's assume everybody's on calendar. So your accountant comes to you in January and he says, oh, by the way, you have a nice profit here of $100,000, and you go, a profit of $100,000. Oh, and he says, oh, by the way, you're going to be paying tax on that. So if you're passed through, which is Mitch and I agrees you should be, whether you're an LLC or whether you're an S corp, you're passed through. So $100,000 is going on your tax return as earned income. You earned an extra $100,000. You're going to have to pay a tax of $33,000 if you're in the wonderful state of New York. $47,000, California, who knows what, probably $47,000. You have to pay that tax on what I call phantom income, because you turn to your accountant and you go, I have an extra $100,000. Where is it? He goes, well, you're on the accrual basis. You sent out your bills in January or in December. Well, the minute you invoiced your bills, you accrued that income. So you now have that income. Now, not only is invoicing one issue, you sign up jobs. You put sales on your books. You got $300,000 worth of new sales in December. Maybe you didn't put them in yet. How is that an asset? All right, anyway, I'm gonna let Mitch get on and explain all it. But to me, a simple businessman now, not lawyer, businessman. I operate my business very simply. Here's the money I've got. Here's the bills I have to pay. This is exactly what I've got. When I end the year and I say zero in my bank account, and I owe nobody any, I owe no money. And my accountants used to kill me every year. You know why? Because they come back to me January and February before the return gets filed, and they say, well, wait a minute. Yeah, you zeroed out your ledger, but you didn't zero out your bank account. So you wrote $50,000 worth of checks to the courts, and they haven't deposited them yet. And it's too late. You now have to recapture that because you didn't spend the money. So you ended, according to your bank, you've got $50,000 in the bank that you're going to have to pick that up on your personal tax return. And I routinely go nuts. I go, I didn't get that money, and why am I paying tax on it? And that's the answer. Now, if you're on accrual, you're going to be getting that every year from your accountant, okay? And Mitch is smiling because he knows I think he's going to say I'm right.
No, I'm not going to say you're right.
All right, well, guess what? There's only one way. Wait, I'm going to tell you how Mitch would have a smile on his face, and you'll be very happy. If Mitch comes back and tells you at the end of the year, oh, you got all these losses. You lost all this money. It's coming off your, well, I don't have losses, so I can't relate to that. And I hope, and none of my concierge clients have losses, and none of my clients have losses. So Mitch, I don't know who you're talking to, but not a failed alarm company. This industry, we make money. We need to be on case. Now I'm going to let Mitch respond. There you go, Mitch. It's all yours.
Let me tell you, I never have a smile on my face when my clients have losses. I want my clients to have profits. But in accounting, there are three basic financial statements. Everybody knows about the income statement, the profit and loss statement. What's your revenue? What's your expense? What's your net income? That's the basic one. The balance sheet, which is one that as companies start to grow, they start to understand, is the accounts that aren't income accounts, your cash, your accounts receivable, your accounts payable, your loans, those type of things. But there's a third financial statement that most companies don't do, that we educate our clients to start doing, and that's called the statement of cash flows. And it's a required financial statement for any company that's audited or reviewed. The major companies use it. That is the financial statement that tells you what your cash is. Because here's what happens with accrual accounting, where there's a fundamental misunderstanding on Ken's part. Until you actually do the work and the customer is ready to pay you and you've conformed whatever the contract was, in accrual accounting, it's not income. So let's say a client gives me a check today for a camera install that we're going to do in March, and he gives me a $20,000 down payment. In accrual accounting, believe it or not, that is a balance sheet item. That is a deposit that goes into my cash, and it's a liability that goes onto my balance sheet. And until I actually do the work and get it ready to bill, it's not income. And that's a fundamental mistake and a fundamental issue with cash basis, is that on cash basis, that was income. I got the cash and I got to pay tax on it. But the theory behind that is you haven't done the work yet. It's not income yet. If a customer called and canceled, you may end up having to get the money back. And so it's not income until you earn it. And that happens a lot in this industry. But what the statement of cash flows tells me is, let's say I got through the year and I had a lot of these deposits and a lot of these other issues. And I ended up grossing $3 million, and I had expenses of $2 million. So I've got $1 million of income. But sitting out there, I've got $500,000 of deposits that I've taken. And I've got another issue that my accounts receivable went way up. I had a bunch of customers that are not paying me. So the statement of cash flow says, okay, you had $1 million of income this year, but your accounts receivable, customers that haven't paid you, it went up from $200,000 to $800,000. And that's because I've got a big project where they didn't give me a deposit. We started doing the work, but they're not paying us. And we know we're going to get paid eventually. It could be a county or it could be a large corporation or something. They're not going to pay me until it's over. So that ate up a bunch of my cash. I had $600,000 of cash that my AR went up, and I don't have it yet. I got $1 million of income, but I've got $600,000 tied up in receivables, and it works its way on down. I purchased a truck. I paid $50,000 for it. I'm going to depreciate it at $10,000 a year, but I spent $50,000 for it. I paid down a loan. I paid off some payables earlier, and it comes down to the bottom line. And when I look at the bottom line, my statement of cash flows, my cash went down by $200,000 because I didn't collect my receivables. I paid off some payables. I paid off a loan. I bought a truck. I did all these other things. We do these things for our clients monthly. And so before the end of the year, when they realize that they owe a bunch of money in taxes, they say, hey, wait a second, I'm burning cash because my receivables are going up, my payables are going down. I need to stop this. I need to look at it. I need to borrow money from the bank or something because I'm going to come to the end of the year without cash. On the other side of the coin, it could be the opposite. You could have gotten a lot of deposits for a lot of jobs you haven't done yet. So you haven't booked the income, and you come to the end of the year, and on a cash basis, you've got $600,000 of income. You pay the tax on it on an accrual basis, and they only have $100,000 of income. Now, you got that money sitting in the bank because you've got deposits, but you can't spend it because you haven't done the work yet. And so the nice thing about accrual basis is it matches the expense with the period in which you actually get the revenue. So if I get a deposit for a project in December that I don't do until March, my payroll is going to hit in March. I'm going to buy my materials in March. Why should my revenue hit my income statement in March so I can sit back and say, oh, there's a $200,000 project. We got the deposit for $100,000 in December. We did the work in March. We booked $200,000 of revenue. We cut the invoice and $100,000 in expenses for payroll and for parts. And then next month, we're going to get paid the other $100,000, but I've got the whole $200,000 booked now. It helps you run your business. It helps you see when your income is. And Ken's right. If you're working on cash basis, and everything is cash basis, your expenses don't happen until you pay them. Your revenue happens when you get paid, and it can really distort your tax situation, especially if you're not getting paid very quickly, and you're, or if you're paying expenses before you get paid, and your income goes all over the place. But accrual accounting is probably something for an entire seminar about. It's something that they touch on in a first semester accounting class. I've had about 18 accounting classes and worked for a CPA firm for 9 years and have been doing this for 42 years. The big companies, especially the successful companies in this business, use accrual accounting, and they track it better. In Ken's business, it's profitable year after year. He doesn't have as much of a need to match expenses with revenue because he's pretty much getting paid as he does work. But in this business, there's often a long time before the time you pre-wire a large project and the contractor calls you back and says it's time to trim it out. And you need to make sure you're matching the revenue for the pre-wire with the expenses for the materials and the labor, and not booking the revenue for the finish out 3 months down the road, booking it now and it's not coming until 3 months down the road, or not getting the revenue booked for the pre-wire until you finish the project and get paid. It makes your income statement pretty unreliable. You have no idea how much money you're making because this is a business different than a service business. My expenses come pretty much the day I do the work. Ken's expenses come pretty much the day he does the work. Alarm companies have inventory. They have to order parts. They have to wait on contractors to get things finished up. They take deposits. They have a hard time collecting sometimes. Their income can go all over the place on a cash basis. Accrual basis smooths it out. And that's
all right, Mitch. You might have convinced me, but I'm cutting you off because we have another question here. I will say this to you. I think one of the issues I might be having is what struck me about what you said was how you seem to communicate with your clients monthly. So my accountant contacts me a couple of times during the year telling me how he's going to come in and see me, which he never does. And then I hear from him about 1 hour on the very last day that the money is owed. And he says, by the way, we're taking X dollars out of your account, this account, that account, that account, that account to pay your taxes. And every year I marvel and I go, what makes you think that that money is there? Okay, which is whatever. Anyway, that's for another time also.
telling
do
somebody at the very end of the year that they owe money. We have this conversation with our clients that would like to have it in November. And
I know. Don't remind me. Listen, here's a question from one of the participants here regarding health insurance. If I were able to prepay 6 months of employee health insurance in December 24 for January through June in 25, can I take the write-off in 2024?
if you're cash basis, yes, you can. Is when you pay the expense of your accrual basis. We just went through that today. A client paid for 4 months of health insurance ahead of time, and they're going to take the expense in 1/4 this month and 1/3 each of the first 3 months of next year. It is an advantage to make deposits and pay things ahead of time cash basis, but I don't think it helps you run your company. If your health insurance bill is $20,000 a month and you pay it 4 months in advance, it doesn't mean your health insurance expense this month was $80,000.
Well,
and it
Mitch,
makes your financial statement
I
look funny.
think there's something you need to be careful about, though. So, for example, I pay my rent every month, and now I'm in the month of December, and I've paid 12 months worth of rent, and I have a windfall towards the end of the month. Not a windfall, but I collect a large fee at the end of December. And I have basically 2 choices. I don't have any expenses. I have no expenses. I'm already taking care of whatever expenses I have, no debt. And what am I going to do with that money? So I go, you know what? I'm going to pay my rent for 2025 right now in December of 2024. So I've tried that before, and my accountant has said to me, well, you can't do it. One of the things that they're going to look at, they're going to let you take 12 months worth of rent. They're not going to let you take more, and they're not going to let you prepay that. And so in that particular year, I didn't do it. So I don't know how you feel about that, but that's similar to this. Here he talked about health insurance, but it just as well could have been any bill. You could send ADI an extra $30,000 just to put on account. That's the thinking. By the way, the fellow who asked the question agrees with me, but and he says that's logical. But you know what? You can't look at logic very often in law or probably taxes. So Mitch, what do you think about that?
Paying a year ahead of time for no reason is definitely gonna get flagged by a revenue agent in an audit. Making a deposit against stuff that you haven't even bought yet is definitely going to get flagged. He asked me about paying his health insurance 4 months in advance. There's not uncommon for health insurance companies to bill that way and bill you up front to get ahead of it. If it's more than that, I would have definitely said, no, that's not a good idea, because the revenue agent's going to look at it and say, you're just trying to move a deduction from one year to the other. Now, at the end of the day, they're going to audit the next year, and you had deductions this year that you didn't have next year. So this year's going to go, income's going to go up, next year's income going to go down. It's going to net itself out. You'll spend a lot of money getting there, but you're not going to pay a tremendous difference in taxes. Doing it for a year is not good. Paying an invoice that you got for 4 months from the insurance company this year to get it paid before the end of the year, I can support that in an audit from a revenue agent, because you're only going to make 8 payments next year. But on a wild hair, just paying stuff a year in advance is going to get you in trouble in a tax audit.
Okay. All right. Last call, as they say at the places Mitch frequents. Time to. Any more questions? Otherwise, we're coming up on the hour, and I want to thank Mitch for sharing his great knowledge. I don't think there is anyone with comparable knowledge in the industry when it comes to taxes. Yes, this webinar is being recorded, and it will be posted in a couple of days, as soon as someone in my office who knows how to post does it. And it'll be there as long as the K&K website survives, which might outlast me and Mitch, I'm not sure. But it'll be available to you so that you can watch it again. And of course, Mitch is available by phone or email, and he's accessible and available, and he gets back to you right away. and he's all about the business. So if you don't have any hesitation in contacting Mitch about things that you need done, and don't have any hesitation about engaging him as your accountant or your consultant or your tax advisor. By the way, another thing that Mitch does, which I don't, is due diligence on these deals. I don't know if you mentioned that, but that's another service that he does. And I have a deal right now that I'm brokering and I'm counsel on it, and the company's brought in Mitch to do the due diligence, which is an arduous task and an impossible one unless you know the industry, which he does. So he can get in and take care of it real quick. And he's got a skilled staff, by the way, that does it. So the drudgery work, I guess, if that's what you want to call it, is done by his staff, and Mitch oversees it. And they know what they're doing, and they've done it. They've done a lot of it. Mitch has done also. I should have included this in the introduction. He's done a lot of expert witness type of testimony about worth. I know that I have on my website, what's my alarm company worth, but that's not a real in-depth analysis for purposes of perhaps a state audit or a contested divorce proceeding where you're fighting over the value of a business. So something like that, I refer it out to Mitch, because he'll do a much more thorough type of tax analysis type of approach to it. Okay, but he's good at the due diligence, and a lot of companies ask, what do I do about due diligence? And I go, I don't know, but don't ask me to do it, because I'm not doing it, because it's a complicated type of thing to do. If you don't know what you're doing, that's for sure. And you don't have time to do it. You're buying or selling a business. You really don't have time to get involved in it. You're better off hiring someone, bringing them in. Okay, there are a handful of other guys that do it, but like if you're going to be borrowing money, for example, Worcester is a good one to do it, because he's going to have to do it anyway if he's going to loan you money. So you might as well let him do the due diligence too. Although, and I don't think Mitch sees him as a competitor, but they both have enough work, I think. Okay, Mitch, anything else?
Yeah, you made the first step, picking Ken's group as your attorneys, and look to us for any accounting issues, and glad to have the opportunity, and see you in 2025.
Well, hopefully we'll see you all in Vegas. Maybe we'll get Mitch to do one of his webinars there and meet you all personally there. We'll see. That worked out last year. We're going to try and do it again this year. I don't know whether he's going to do it with us, but I'll be there with my staff, folks. I hope to see all of you there. Please book some time with me. Unless I can get away with it, it'll be free time. You don't have to pay me. And Mitch too. A rare opportunity to meet Mitch and not have to pay him. Right, Mitch?
There we go. See you in Vegas, and see everybody else in 2025.
All right, everybody. Have a happy, healthy new year. Bye-bye.
Thank you. Bye-bye.